Saving money is a smart financial move, but understanding how your bank actually grows that money behind the scenes makes a massive difference in maximizing your returns. Roger Bank structures its savings accounts with specific calculation methods designed to reward consistent balance growth over time. Knowing these mechanics helps you optimize when you deposit funds, how often your money compounds, and what you can expect to see in your account statement each month. At the core of how Roger Bank calculates interest is the daily balance method. Unlike traditional institutions that might look at your lowest balance during a statement cycle or just your end-of-month total, Roger Bank tracks the exact amount of money sitting in your savings account at the end of every single calendar day. This means your daily closing balance serves as the foundation for the interest calculation, ensuring that every dollar earns its keep for the exact number of days it resides in the account. To transition from a daily total to an annual percentage yield, the bank applies your applicable interest rate using a daily periodic rate formula. The institution takes your stated annual interest rate and divides it by 365 days to determine the daily rate. That daily rate is then multiplied against your daily ending balance. If you maintain a consistent balance throughout the week, that calculation runs 7 times a week, accumulating interest earnings continuously in the background. Compounding frequency plays a vital role in accelerating this growth process. Roger Bank compounds the interest it calculates on a monthly basis. Instead of paying out or compounding your earnings only once a year, the daily interest amounts accumulated throughout the month are totaled up and added directly to your principal balance at the end of the monthly cycle. Once that interest is credited, it starts earning its own interest going forward, creating a compounding effect that builds momentum over time. Timing your deposits and withdrawals strategically influences your overall earnings because of this daily tracking system. If you deposit a large sum near the beginning of the month, those funds contribute to your daily balance for 30 days, maximizing the interest generated for that period. Conversely, withdrawing funds right before the end of the monthly compounding cycle means you miss out on the daily calculation for those specific amounts during the days they were absent. Keeping a steady or growing balance ensures you capture the full benefit of the daily rate. Fees, minimum balance requirements, and account tiers can also impact your net interest earnings. Roger Bank structures certain savings accounts with tiered rates where higher balances unlock better annual percentage yields, while falling below a certain threshold might temporarily reduce your earnings or trigger maintenance fees that eat into your accumulated interest. Reviewing your specific account agreement clarifies whether maintaining a specific balance tier is necessary to keep your interest earnings operating at their highest potential tier. Maximizing your returns with Roger Bank ultimately comes down to understanding these underlying mathematical mechanics and aligning your cash flow habits accordingly. By keeping your balances stable, making deposits early in the calculation cycle, and letting the monthly compounding work in your favor, you ensure your savings grow as efficiently as possible without needing to constantly monitor day-to-day market fluctuations.